Hey, here we are again, right? Ready to start. They just played that snazzy music and now we're ready to go. Has anybody here ever listened to that music at the start of it? Is it me or does it sound like the music for a really bad 1990s sitcom? Is it right, you know? I expect to kind of stumble in and trip over something or... but anyway, let's go ahead and start. Seems like I assigned a lot of homework. So, did I? How long did it take? Not too bad? Okay, good. Well, let's dive right in there. I'm going to do them a little bit out of order. The first one I want to do is problem 8.1a. Okay, 8.1a. So let's go ahead and do that. That's on page 349 in your book. Problem 8.1a. For each of these 5 separate cases, identify the principle or principles of internal control that are violated. Recommend what the business should do to ensure adherence to principles of internal control. Okay? All right, number 1, Heather Flatt records all incoming customer cash receipts for her employer and posts the customer payments to the respective accounts. Okay, what is violated here? What are they doing wrong?
You only have one person working both of the...
Okay. This is a violation of the separation of duties. Okay? This same person should not be recording cash receipts and posting the payments to the customer accounts. Okay? So you want to try to separate out those duties. Correct? Okay. Second one. At Netco Company, Jeff and Jose alternate lunch hours. Jeff is the petty cash custodian, but if someone needs petty cash when he's at lunch, Jose fills in as custodian. Okay. What is the principle that's violated there? This would be a violation of the principle of establishing responsibility. Remember how I said at a bank you wouldn't just say, hey, go to whatever bank teller drawer you want. No, you would say, this is your drawer, this is your drawer, this is your drawer. Now, I think it says Jeff is the petty cash custodian. So either I would say he's the only one who can be the petty cash custodian, or I would have 2 petty cash accounts. And I would put Jeff in charge of one and Jose in charge of the other. And that way, if there's a discrepancy, you know who to go talk to, right? Okay? You could do that at a company. Couldn't you have 2 petty cash accounts? To me, that makes better sense than just dipping into the same box. Because if something's wrong, Jose's going to say, Jeff did it, and Jeff's going to say, Jose did it, right? So you might just have 2 separate boxes, but you're responsible for this one, you're responsible for this one. Okay? Number 3, Nadine Cox posts all patient charges and payments at the Dole Medical Clinic. Each night, Nadine backs up the computerized accounting system to a tape and stores the tape in a locked file at her desk. Okay, what is what's the principle violated there? It's a little harder one. I don't know if I would have got that one. The principle that they violated was actually the application of technological controls. Okay, the problem here is that it's good that she's backing these up, but she shouldn't be storing them in her desk. Okay? What happens if the whole place burns down? That could happen, couldn't it? Okay? She should take these home or take it to a different site or whatever. Now, this used to be a common situation, that people would make a backup and take the backup home, so that if the company was broken into or if it caught on fire or whatever, you would have a safe backup. Now, largely, what are companies largely doing now? Yeah, they're backing up using the internet or something. Okay, I do Quicken for my home finances, and I back up on the internet. I have a website where I back up over there. So if something happened to my computer or whatever, if my house burned down, I could go out to that internet and have a backup there. Does that make sense? Mm-hmm. Okay, so you want to have a backup that's safe. Number 4, Bartow Sales prides himself on hiring quality workers who require little supervision. As office manager, Bartow gives his employees full discretion over their tasks, and for years he has seen no reason to perform independent review of their work. Well, what's the one violated there? No reviews are going on. He needs to independently review these workers. And that's great that he thinks he's doing such a great job, but we've talked about many instances where that wonderful employee that you never would have thought was stealing from the company was in fact stealing from the company. So you have to perform independent reviews, okay? Or hire an internal auditor come in and perform independent reviews, okay? All right, number 5, Desi West's manager has told her to reduce costs. Desi decides to raise the deductible on the plant's property insurance from $5,000 to $10,000. This cuts the property insurance premium in half. In a related move, she decides that bonding the plant's employees is a waste of money since the company has not experienced any losses due to employee theft. Desi saves the entire amount of the bonding insurance premium by dropping the bonding insurance. Obviously, the principle violated here is to insure assets and bond key employees, okay? Now, if they have to raise the deductible, that's one thing. Sometimes you do that, and sometimes it financially makes sense to do so. However, I would not cease bonding key employees, okay, for the reasons that we've talked about in previous lectures, okay? Questions on those? Okay, those are just some good scenarios to kind of walk through and see if you understand these principles. All right, let's go ahead and jump to problem 8-4A on page 350. Now, I should have told you, I apologize, you only needed to do the first and second requirement on here. So if you folks at home, hopefully you're not mad at me. I will put up the answer real quick if you want to look at it, but I'm not going to spend a lot of time talking about it, okay? But did you guys get this one to reconcile? Okay. All right, let's take a look at this. The following information is available to reconcile Clark Company's book balance of cash with its bank statement cash balance as of July 30, 2011. Okay. On July 31st, the company's cash account, their books has a 26,193 debit balance, but its bank statement balance shows a 28,020 cash balance, okay? So we've got a difference in balances here, right? We have a difference in balances here. And so here's what we're dealing with to begin with, okay? See if you can see that. Okay? So now we have to go through these items and decide which side they go on and if they're added or subtracted, okay? The questions I always ask are, who already knows about these and it's in their records versus who's just now finding out about them. Whoever's just now finding out about them or doesn't know about them yet, that's whose side it goes on. And then you ask yourself, when they do find out about it, are they going to add it or subtract it from that balance? Does that make sense? Okay, let's take a look. B, check number 3031 for $1,380 and 3040 for $552 were outstanding on the June 30 bank reconciliation. Now we're doing the July one, right? Okay. Now check number 3040 is listed with the July canceled checks, but check number 3031 is not. Okay, some people struggle with that terminology. When they say it's listed with the canceled checks, that means it's cleared the bank. It's gone through the system. Okay? Now, that might have been a little confusing, but that's a terminology that's sometimes people think a canceled check means like you destroyed it or wrote it off or something. No. In this terminology, and people still use this, is a list of the canceled checks means it's gone through the system. They're no longer outstanding. Okay? So of those two checks, 3031 and 3040, only 3031 is still outstanding. So we've got that one check. However, also check number 3065 for 336 and check number 3069 for 2148, both written in July, are not among the canceled checks. That means those are outstanding. So those are our outstanding checks. Okay, now I'm going to have to show you this whole thing, but I'll show you where these go. So those are your outstanding checks, and that's the total of them. Okay? Those are the checks that have not been canceled. Okay? They haven't gone through the system. Okay, let's read the next one. In comparing the canceled checks on the bank statement with the entries in the accounting record, it is found that check number 3056 for July rent was correctly written and drawn for $12.50, but we mistakenly entered it in the accounting records as $12.30. Okay? All right. So come back to me. We should have reduced our cash by $12.50. We only reduced our cash by $12.30. So we got to reduce it for the other 20 bucks, don't we? So this is on the book side. This is a book error for 20 bucks and it's deducted. So it's right there. Questions thus far? Okay, D, a credit memo enclosed with the July bank statement indicates that the bank collected $9,000 cash on a non-interest bearing note for Clark, deducted a $45 collection fee, and credited the remainder to its account. They have not recorded this event. Okay, so who's just finding out about this? We are, right? The bank knew about it. We're just finding out that they collected this $9,000 note less the $45 collection fee. So we are collecting a total net amount of $8,955, right? So the way we show that on the bank rec is it's on the book side, and like I said, we add it. So it goes right here, doesn't it? Now, some people might have shown a collection of $9,000 here and a deduction down here of $45. That'd be okay. It'd be the same net effect, wouldn't it? Okay? But that's on the book side as an addition. All right? Okay. E, a debit memo for 805 lists a $795 non-sufficient funds check plus a $10 non-sufficient funds charge. The check had been received from a customer, Jim Shaw. Clark has not yet recorded this check as non-sufficient funds. Okay, so we collected this check from Jim Shaw thinking that it would clear, and we increased our cash records, and did it clear? No. So we got to back that baby out, don't we? Okay? So, let's see how we do this. How much was the check for? The check was for $795, and then there is a $10 non-sufficient funds check. So we have to back a total of $805 off our records. So there it is right there. Okay? That deadbeat, his check didn't clear, did it? Okay? So that's not a fee we're charging him. That's a fee the bank charged us. And we might just pass that along to Mr. Shaw. Okay? We might just pay him a visit at his home. We might break his legs. No, I'm kidding. We don't do that anymore. Okay? In the old days, that's what they did. All right? F. Enclosed with the July statement is a 15 debit memo for bank services. It's not been recorded yet. Okay, the bank knows about this. We're just finding out about it, right? Now that we're finding out about it, is it a deduction or an addition to our cash? It's a deduction. So it shows right here on our bank rec. $15 service charge deducted. Cool? All right. Finally on G, Clark's July 31 daily cash receipts of $10,152 were placed in the bank's night depository on that date, but did not appear on the statement yet. This is a deposit in transit, isn't it? So deposit in transit, who doesn't yet know about this? The bank. When they find out about it, are they going to add it or subtract it? They're going to add it. So it's listed right here. Okay? The adjusted bank balance is $34,308. The adjusted book balance is $34,308. We got a reconciliation, don't we? Yay. Now, this is a formal something that you would keep, a statement that you would file with that statement. Probably would sign it, whoever did this reconciliation. Leave a record of who did it, what date they did it, all that sort of stuff. Did you guys get this? This is a little harder one though, isn't it? Okay. All right. Questions on that? Okie doke. Now, the next thing I wanted you to do was to do the journal entries. Okay? Now, going back to that reconciliation, Do we do journal entries for the left side or for the right side? The right side, right? Okay. Now, let's go ahead and let me see how. I think they combined entries. No, let's go ahead and take a look at that. Okay, the first one is we have to debit cash for 8955, right? Don't we? We have to debit cash for 8955. So that part of the journal entry writes itself, correct? Now what's the rest of it? Well, we need to decrease our receivable by 9,000, right? So we have to record that collection expense. You have to make sure you don't just decrease your receivable by $89.55 because that's going to imply that this person still owes us 45 bucks, right? And they don't. They owed us 9,000. We collected $89.55. That's all we're going to collect. And so you do have to record that collection expense of 45 in the manner shown. Okay? Okay, what's the next thing? This non-sufficient funds check for 805. Well, we have to reestablish that receivable, don't we? We have to reestablish that receivable from Mr. Good old Jim Shaw. So we debit accounts receivable Jim Shaw for 805 and credit cash for 805. And in real life, we might even add another 50 bucks on there. And say you have an accounts receivable for $855, and then we would have to credit some sort of revenue account, like revenue from uncollected accounts or something, to offset that. But you ever been in a grocery store and it says bounced checks have a fee of such and such attached to them? That means if you bounce a check for 100 bucks, you're going to end up paying them 130 bucks if that's what their fee is, because they probably want you to pay their $10 bank fee that they had to pay, plus $20 for just being a pain in their rear end. Okay? All right? Okay. Next item we have on here is a service charge. And we have to credit or reduce cash. So that's what that looks like. You could debit banking expense if you'd like. Okay? And then the last thing is there's an error for $20. Now we know we're going to credit cash, right? Because this is a deduction from cash, and we reduce cash. This is a deduction from cash. We know we reduce cash by crediting it, correct? But what are we going to debit? Well, look back at what the original entry was. We should have debited originally, which item is this? Which one is it? C. We should have debited rent expense for $12.50, but we only debited it originally for $12.30, right? So we have to make that other $20 debit to rent expense. So that expense account is also properly recorded. You with me? Cool? Mm-hmm. Did you guys get that? Is that kind of hard? How many people got that to reconcile? Okay, just a couple of you. Okay, that was a harder one. I know it was. Why don't you go ahead and I'm going to put the answer to part 3 up there. I don't require this, but every now and then there's somebody at home who did it because they thought they were supposed to, and it drives them crazy not to know the answer. So if you're in that camp, you can take a look at that. I'm not going to really talk through it because I don't want to confuse what we know. Okay, I think it's kind of counterproductive. So don't worry about this. It's only up there for you folks at home if you really, really have to know the answer. But I would just encourage you just to not worry about it. Okay? Okay, we are done with bank recs. However, I want to tell you one thing. For you folks here live and for you folks at home, in the handout section under lessons under chapter 9, I went ahead and put one more bank rec. and it's the Betsy Doe Company bank rec, okay? And it is out there under Chapter 9 handouts, under the Lessons tab. It is out there along with the answer if you want a little bit more practice on doing bank recs, okay? Not going to go over it in class at all. If you can't, if you look at the answer and you still can't figure it out, well then get a hold of me, however, and we can talk through it. But I'm not going to go through this. This is just one out there if you want a little extra practice. Make sense? Okay, let's go ahead and jump over to Quick Study 811. Quick Study 811. Okay? All right. Quick Study 811. An entrepreneur commented that a bank rec may not be necessary as she regularly reviews her online bank statement for any unusual items and errors. Describe how a bank rec and an online review or reading of the bank statement are not equivalent. Okay? All right. How are they different? Well, let me go ahead and read the second question, because maybe you'll be answering both of these questions kind of at the same time. The next thing they ask is identify and explain at least 2 frauds or errors that would be uncovered through a bank reconciliation, but wouldn't be covered through an online review of the bank statement. Okay? All right. What do you think?
Well, in your books, I feel like that's the most current. Like, there may be errors. There could be errors on both sides, but like in the examples we've done when the cash receipts haven't been deposited in the bank yet.
Yeah.
But you have it in your books.
Okay. Okay. Yes, and what you're pointing out is that a reconciliation is a formal looking at your books compared to the bank, going through each item to see if it works, right? If it reconciles. And you have this set of books who you hopefully is current and that you feel confident with. And you compare it and you perform this formal reconciliation, right? This is why a lot of people, I actually do my bank rec not every month, I just do it every week. Okay? I do it every week because I know my last week's activity a lot better. If I look at 3 or 4 weeks of activity ago, I'm like, I can't remember that stuff. You know what I mean? And it's just easier. I can just do it really quick. So you're right, Sarah. I would say that. What are some of the errors that would not be uncovered by just perusing your online activity that would be caught by a bank rec?
Different figures on checks, like what you have on an invoice.
Very good. Now you might see that you always pay the, you have a vendor that, you know your vendors kind of by now, and let's say you always pay, AT&T, okay? Well, what if there was an erroneous payment to AT&T? Or they double billed you, or they billed you for somebody else's charges or something like that. You see what I'm saying? Well, you're just looking for things. Okay, there's AT&T, that looks fine. You see what I'm saying? You're not going to catch that, are you? Okay, what's something else that you wouldn't catch?
Like a typing error if you deposited a check for like $8.55 and they only put it in for like $8.45 or something.
Yeah, an error on a deposit. Maybe they put it in at the wrong amount, or maybe they didn't put it in at all and you're just not seeing it. But errors of omission are hard to catch, aren't they? Mm-hmm. But you're right. You're right, Cassie. They might have made the deposit, but it was at a different amount. Okay, good. That would not be caught in just a perusal of online activity. Okay? Maybe the payment was made, but it was supposed to be made from a different one of your checking accounts than the one that was made. Or maybe they made it from both of them accidentally. And you're just looking through and, oh, that looks good. Oh, that looks good. It's the same payment. Can't stress enough the need to do. Don't even start a business if you don't want to do a bank reconciliation, because it's one of the most basic and important of internal control functions. And you're going to get ripped off if you don't do it. There's a good chance you will be eventually. And it's just such a basic part of doing business that if you don't want to do it, then you need to reevaluate if you should even have a company, correct? I know that sounds harsh, but I tell you that because I care, all right? All right, so that, okay, there might be others, but I think that's a pretty good discussion of that. Any other comments on that or things that you came up with? Okay, all right, let's go jump over. We're going to spend a lot of time today just going over homework, aren't we? That's all right. Quick study 8.7. Quick study 8.7. The following annual account balances are taken from pro team sports at December 31st. They give us the AR and they give us the net sales for both 2010 and 2011. What is the change in the number of days sales uncollected between those years? Is it improving or getting worse? Okay. Well, first let's talk about just the basic interpretation or the basic calculation of it. All right, did you get, let me adjust this. First of all, how do we calculate it? Well, we take accounts receivable divided by net sales times 365, right? So for 2011, it was 10.7 days. For 2010, it was 11.2. Okay? So it's going from there to there, right? Is it getting better or worse? It's improving, isn't it? Okay? It's improved by half a day. That's good. What might be some reasons that it's improving? What might be some reasons that our receivables are coming in quicker? Maybe we changed our credit policy and we offer a larger incentive for payment. Remember the 210 net 60? Maybe we changed it to 210 net 30 or 310 net 30. Okay? Maybe we have a new credit manager she's really awesome. And when accounts get old at all, she gets on it. And in the past, we were kind of lazy about it. Maybe the economy is improving. Probably not. Probably one of the other reasons. Okay? All right? But as you can see here, this has gotten better, right? And I don't think they give us any competitors' information to compare this to. I'd be interested to see what it was for 2009, 2008, 2007. Really do a strong trend analysis on this, right? Okay? I think you'd have a little bit more accurate interpretation, but this is a good basic one. Okay? All right, I think that's it for chapter 8, isn't it? It's a good chapter. An important chapter. But that's all the homework I assigned for it, wasn't it? Is that correct?
Yeah, we did 9 too as well.
Yeah, we're going to do exercise 9 too, but that's the only homework I did from chapter 8.
Yes.
Okay. All right, let's hop over to exercise 9.2. Exercise 9.2. This goes to the information I was talking about as far as we have our accounts receivable control account and we have our subsidiary detail. And the total of the detail has to equal what's in the control account. Remember when we discussed that last lecture? So whenever you do a debit or credit to accounts receivable, you need to do it to both the control account and to the customer detail. All right? Okay, let's read this. Sammy Company recorded the following selected transactions during November 2011. We're on exercise 9.2. And you can see that there, right? I won't read all those. Open a general ledger account having a T account for accounts receivable, sales and sales returns and allowances. Or let me say that a little different. A T account for accounts receivable, sales returns and allowances. Also open an accounts receivable subsidiary ledger having a T account for each customer. And then they want you to post these to both the GL and the AR ledger. Correct? So let's do that. Now, first of all, whenever this is a little hard to do with the constrained. This is something that if I had a bunch of whiteboards and you could see them all, I could walk through this a little differently, but that's okay. We'll deal with what we got. This is the information that they give you, correct? Let me blow that up a little bit, as large as I can. Okay. Now the way you want to post these things is whenever you post, you want to do it line by line. Like, okay, accounts receivable surf shop, a debit for 4417. So I want to debit the control account for 4417, and I want to go over to the customer detail for surf shop and debit it for 4417. Okay? Then I want to credit sales for 4417. Oops, can't see that, can you? Then I want to go to accounts receivable for Yum Enterprises. Whenever I do a debit or credit to accounts receivable, I have to take it to both the control account and to the detail, right? Then I do the next line. And you might say, well, how else would you do it? Well, some people just look at it in its entirety and they go, okay, let me do all the sales first, and then let me do all the accounts receivables, and then you always end up missing one. You always end up skipping one. So just go take care of business line by line, okay? Chronologically. Now, when that's all said and done, you should have information that looks like this, okay? This is your control account, and this is your subsidiary accounts receivable ledger. Sometimes we call this the subsidiary detail. Okay? And you can see that. Each one of those is posted. Right? Okay? So, the total of the accounts receivable control account at the end of the period is 8817, right? Is that the total of the ending balances for the subsidiary detail? Does 7023 plus 1250 plus 5544 equal 8817? It does, doesn't it? And that's the key. You can see, like that November 5th, they posted it to the control account and to the detail. That November 10th, they posted it to the control account and to the detail. Even when there was a credit on November 21st, they posted the credit to the control account and also the credit to the subsidiary detail. You always have to go both places. Make sense? Questions? Okay, then they wanted us to prepare a schedule of accounts receivable. Is that correct? Now this is a pretty basic, simple example. There's only 3 customers. But for most cases, there would be many, many, many customers, wouldn't there? Okay? So the schedule of accounts receivable as of November 30th, 2011 simply lists each of our customers and what they owe us in receivable at that date. And it's to verify that 8817 is the amount of accounts receivable that would show up on the balance sheet if we did a balance sheet at November 30th, wouldn't it? Correct? Make sense, guys? All right, did y'all get that? That's not too hard of a concept, is it? Now I think we're done going through our homework, aren't we? Okay? Great. You guys done with that? Okay. All right, we only have we don't have that much more time. So I'm just going to let you go early. No, I'm just kidding. I'm not going to let you go early. Only a teacher who didn't care about his students lets them go early. Okay, and I care way too much. Okay, I want to take a look a little bit more at chapter 9. Okay, now what I want to do is kind of thinking on the run here. We have talked a little bit about accounts receivable and about the control account versus the subsidiary account, correct? Going to the PowerPoint, another real quick term that I just want to make sure we get in here. There's also something called an installment accounts receivable. And this is when customers owe us from credit sales, but they pay us off in periodic amounts over an extended time period. And sometimes we charge them interest. Okay? Very similar to a notes receivable. But there is, I want you to be familiar with the term installment accounts receivable in case you ever hear it. You've probably heard about this. We're going to pay in installments, right? Okay. Now, I am not going to talk, I'm going to switch the order that I usually do for this chapter. I'm not going to talk right now about credit cards. We'll talk about that later, okay? I want to stay on the subject of pure receivables. Pure receivables being when we sell to a customer and they're going to pay us at a later date, okay? And we're hoping they're going to pay us, right? Okay, that's what I want to continue talking about now. Now, sometimes a customer does not pay us the money they owe. Sometimes we have a receivable from a customer who we provided product or service to, and they did not pay us. Okay? That is called bad debt expense. They owed us money and they didn't pay us. Now, coming off the PowerPoint, let's just talk a little bit. Why might a customer not pay you on your receivable that you have from them? What are some reasons that you may not be able to collect that and you might incur what we call bad debt expense?
Lost the job.
The customer lost their job? Yeah. Sometimes, has anybody here ever done collections? Anybody? You have? Kim? Was it the most miserable job in the world?
Yeah, it's awful. I still do it. I
You
work at a chiropractic clinic and I do the bookkeeping.
You seem like such a nice, sweet person.
I am, and they tease me about it all the time. They like, you need to be stern on the phone, because
Yeah. I've done a little bit of it and I don't like it.
I hate it.
But sometimes when you, and I want to hear some of your comments in this discussion, but do you ever hear people say, I can't pay because I lost my job?
Yeah, but we try to work with them. We as long as they pay something every month, we normally
Yeah.
pretty good.
Yeah, exactly. You try
Yeah.
to work with them. But sometimes people say, hey, I know I owe you the money. I want to pay you. But you know what? I just got laid off. My wife got laid off. We don't have any money. You can come over. You can look in our sofa for coins. You can go through my wallet. You can look at the ashtray in my car. I don't have the money. I'm sorry. I want to pay you. I do not have the money. Have you heard that before?
Yeah.
Okay. So that's one reason they may not, you may not get paid. What are some other reasons that you may not get paid?
Just negligence.
Maybe they're just not very good record keepers. Okay? Maybe the bill, oh yeah, I got to get to that. I'm way behind on everything. Okay? You probably heard that too, haven't you, Kim? Mm-hmm. Yeah, we got that bill somewhere. Can you resend it? Can you resend that bill? I don't think we ever got it. It's like, oh boy. What's their house look like? Okay? Good one. What's some other reason?
They just don't want to pay you.
Maybe they don't want to pay you. Maybe they say, you know what? I know I owe you money, but I tell you what. I know I owe you $300 for this sprinkler system you put in, but this sprinkler system you put in is garbage. It's broken. It's, there's pipes sticking out of the ground. It's just horrible. I'm not going to pay you. I'm not going to pay you. Sorry. The service or product you gave me stinks. Okay? Have you ever heard that one?
Very rarely, but there's been a couple letters, nasty letters, saying they're not going to pay because they didn't like what they got,
Yeah.
basically.
I remember one time I went to a dentist. We were gonna take the kids to a dentist, and we have a dental insurance through the school, and the dental insurance covers routine checkups at certain dental practices. Okay, so there was a new dentist just half a mile from our house, so the wife was going to take the kids to the dentist, and so when she called to set up the appointment, I said, before you set up the appointment, tell them exactly what our insurance is and make sure we're covered. So she did that. She says, yeah, they said they take our insurance, so we have to go in 3 weeks. We got to take the kids. Okay. So we take the kids to the dentist. Before we start the process that day, I say, I just want to make sure. Here's our insurance card. I just want to make sure. Some dentists take this insurance and some don't. They said, we take it. It's cool. Everything's fine. All you got to do is pay your little $10 copay or whatever. I said, good. So the kids go in and get their work done and all this sort of stuff. And We go home and we think everything's fine. Well, they call me a week later and they go, we feel horrible. We feel so bad. We had a new person working the counter, and we don't take your insurance. And I said, oh, really? Actually, they called my wife, and she said, oh, really? And they said, we apologize. What we're going to do is we want to meet you halfway. Okay? They said, we're not going to charge you for the x-rays, but we're going to charge you for the appointments. So the x-rays, which are about $150, don't worry about it. But it is like $170 for the kids' appointments. So if you could pay us, that'd be great. And so my wife tells me this, and I said, we're not going to pay them. I said, we're not going to pay them. And I said, call them and just tell them we're not going to pay them. We double-checked with them, okay? We double-checked with them. So she calls them, and she calls me at work and says, and, you know, my wife's very sweet. You know my wife, some of you. They said we've got to pay. They said we have to pay. They're not going to budge on this. We got to pay, Dave. And my wife thinks if we don't pay, they're going to take away our children and, you know, torch our house. And I said, do not pay. I said, I will take the situation into my hands, okay? So I go home from work, I drive over there, and I said, okay, who owns the business here? And she says, well, can I help you? Do you own the business? Okay, well, then I want to talk to who owns the business. Well, one of the dentists owns the business, and I say, and I'm always very nice about it. I'm saying, hey, here's the situation. We checked not once, but twice with you to see if you would take our insurance. You told us both times you do. And thus we had you as our dentist. Now you're telling us we don't. This is not my mistake. This is your mistake. You even admitted it was your mistake. I'm not going to pay you this money. I'm sorry. I'm not going to pay it. And, you know, before I left, my wife said, I guarantee you that you're going to have to pay it. They're just not going to. And, of course, the guy said, you know, you're exactly right. It was our mistake. I said, we wouldn't have come to you. We wouldn't have gone through this if you hadn't, you know. This is why I pay dental insurance, right? So they had a receivable from Dave Krug that just never did get paid, and they had to write it off, and we'll talk about that. But, and I told him, I said, my credit is squeaky clean. I pay all my bills, but I'm not going to pay you. And I was nice about it, and sure enough, we didn't pay him. But there's an example, right? My wife goes, you had to pay, didn't you? I said, no, I didn't. So we learned something about our marriage. She's the good cop, I'm the bad cop, right? Not always the case. I know men who are the good cop and the wife is the bad cop. But in our marriage, I can be the bad cop if I have to. What's another reason some people don't pay when they owe you money? Here's a good one. They're dead. Have you ever tried to collect money from a dead person?
Well, that's like those in that Storage Wars show. Like the people
Yes.
die and they don't pay their rent.
Yeah.
So.
Have you ever had a customer you were trying, or client, patient,
Oh, yeah.
and they're dead?
Yeah, we just write it off.
Yeah, because when you talk to a dead person, they just ignore you. It's rude. But it's very hard to get a dead person to write you a check. And sometimes people die. Matter of fact, everyone here in the studio one day will probably die.
Probably.
Okay? I don't know. Maybe God's going to take me straight to heaven. I don't know. But for you, you're all going to die, okay? No, I'm kidding. So it happens. And chances are when we die, we will owe somebody something. Right? Maybe hopefully it's just a little amount. But you don't collect money from dead people. Now, on this, I always said, when customers don't pay, is that always a bad thing? And always, students are always like, what? Of course it's a bad thing. Well, here's the analogy I'm going to use. Okay, I teach Accounting 1 every semester, 2 or 3 sections of it. And there's about 70 or 80 people that take it, okay? Now, let me ask you this. If somebody flunks, is that always a bad thing? Well, here's the deal. If 90% of my class or 95% of my class don't flunk and 5% flunk, I'm really okay with it. I mean, seriously, I'm really okay with it. I mean, I'm sad, but Why might if 100% of my class got an A, what would that tell you about as an instructor? It's too easy. It's too easy, or people are cheating.
Well, you're just that good.
No, I don't even think it's, I'd like to think it's because I'm that good, but I'd say not everybody's going to pass the class. Now, if everybody got an A in my class, I would say, I'm too easy. Well, if everybody pays you, if you have 0 bad debt expense from people who you extend credit to, I would say your credit policy terms are too restrictive. Okay? What's one way to guarantee that you never have bad debt expense? Take cash only. The old sign that says, "In God we trust, all others pay cash." You ever seen that? But one way I could guarantee that there's never bad debt expense is say we only accept cash. But what might you do there? Lose a ton of customers. Now, what if somebody like Nebraska Furniture Mart says we're changing our policy? We only accept cash, not checks, but cash, because we're sick of this bad debt expense. They'd go under. Would they not? Remember, the goal in business is not to have 0 bad debt expense. The goal is to have a higher net income, all things being equal, right? You're going to have some bad debt expense, okay? What if you were my bookkeeper, Jessica, and we met every year and we talked about the bad debt that we had in our customers? And one year we were met and you said, I am thrilled to tell you that we have 0 bad debt expense. And we're a pretty large company. And I'm like, really? And you're all happy about it. And I say, well, tell me why we have 0 bad debt expense. And you said, well, I changed our credit terms. I only extend credit to customers if they can prove that they have a $1 million or more net worth. I'd be a little upset at you, wouldn't I? Because yes, we have 0 bad debt expense, but we lost a ton of customers. Do you think credit card companies like Visa, do you think they have bad debt expense? Yes, and I guarantee you this, heads would roll if they had 0. Because somebody would say, we are not extending credit like we should be. We're going to have some bad debt expense. I'm going to have some students, unfortunately, that flunk this class. But I really am okay with it if it's just a minority. I'd be upset at myself if there wasn't a few Fs in a large group over time. Does that make sense? Hopefully you guys won't be one of those Fs. Be some other poor person. Okay? But do you understand what I'm saying about? Some people get all bent out of shape out of bad debt expense. Oh, we got cut. Well, you have to manage it. You have to control the risk, but it's part of doing business. Okay? It's part of doing business. The reason we extend credit is to extend our customer base. Does that make sense?
But aren't there some businesses that still wouldn't have bad debt expense at all? Like,
well, sure.
For some services that you have to pay up front.
Well, Taco Bell, have you ever said, hey, can you put this on my bill?
Valid point.
Okay? I mean, I am sure Taco Bell has some receivables. Maybe from a big catering deal. Maybe you got married and you were so cheap that you catered with Taco Bell. But I bet you if I went in and audited their books, they have some receivables. Somebody do this. Go look at their financial statements and see if they have receivables. But there are a large number of companies that the majority of their sales are cash, right? Go to Dollar General store. You know, they take cash or debit their card or whatever, right? There's no receivables. But there's a lot of other companies that do have receivables. So you're exactly right. You're exactly right. Okay? But for those who do extend credit, if there's some bad debt, you got to manage it, but it's part of doing business, okay? Now, I want to, don't go to the PowerPoint yet. I'm going to actually stop there, okay? And we want to, you know what? I'm not even going to give you any homework. Wow, okay? No homework this period. Yeah, it does not happen much. Oh, wait, there's one. No, I'm just kidding. No homework, but here's what I want to do, folks. Come back to me as I close up. Next lecture is a really important one. I want you to be here. I want you to engage your brains. I want you to bring your calculators because we're going to talk about how we deal with bad debt expense, okay? So no homework. Get some rest. Come back next time and be ready to engage your brain. Bye-bye.